Let's go.
The broadcast is now starting. All attendees are in listen-only mode.
Good morning and welcome to Drewry's Tanker Shipping Market Outlook webinar. My name is Antonia Mitsana and I'm Marketing Manager at Drewry, and I'm joined today by Rajesh Verma, Deputy Director in our bulk research team, Anshika Prajapati, Senior Research Analyst, and Tanisha Mundra, Equity Research Analyst in our Maritime Financial Research team. In today's session, Rajesh and Anshika will give us a summary of our latest research on the tanker shipping market. They will share some key findings from our latest crude and product tanker forecaster reports, and we will discuss the outlook for the market for the remaining of the year and for 2026. Tanisha will then cover profitability and company financials. So this presentation will take us about 20 minutes, and after that we have allocated some times for questions and answers. You can ask us a question using the panel on the right-hand side of your screen, and we will try to answer as many questions as we can today. We will also be sending out a link to the recording of this session tomorrow. So let's begin for the content we have prepared for you today. Rajesh and Anshika, over to you.
Yeah. Thank you, Antonia. So first, over the next 20 years, we'll take you through the Drewry's outlook for 2026 for the tanker market. So first, I'll start with the crude tanker market, and then thereafter, Anshika will take it over for the product tankers market. Now, first of all, like the last year, I'll start with the current market situation. So last year was a mixed bag for the tanker market, wherein while crude tanker rates surged towards the end of the year, especially because of speedy unwinding of the OPEC production curbs, and to some extent because of relatively slower growth in fleet. Whereas the product tanker rates, they declined from their 2024 highs, and that was primarily because of the influx of fresh tonnage in the market. On the asset market side also, that is clearly visible that product tanker rates that were commanding premium as in relation to crude tanker prices that have come down significantly in tandem with the decline in vessel earnings and charter rates. Whereas, although there is slight softening in the crude tanker rates prices also, but overall it is like performing slightly better as compared to product tanker market if we look towards the end of the year prices. On the new building side, although there has been a bit of softening in the recent months, but overall, if you see the levels as compared to pre-COVID levels over the last 3-4 years, new building prices have surged, and in that comparison, asset new building prices are still significantly higher. Now, going back to the outlook for 2026, now there are two parts, one on the supply side and the second one on the demand side. So supply side, if we compare product tanker versus crude tanker, so obviously crude tanker seems to be a clear winner for 2026. Although after a sluggish growth in 2025, there'll be a slight uptick in crude tanker deliveries in 2026, which will lead to around 2% growth in overall crude tanker fleet. But when we compare this with the product tanker market, fleet already like surged by almost 6% in 2025, and it is expected to increase by another 6% in 2026. We can see on the top right chart that the deliveries started surging in 2025, and it will increase further in 2026. So a flurry of deliveries in product tanker market will obviously be a bit of concern for the tonnage utilization in the sector, whereas the overall supply growth in crude tanker market will be relatively slower, which suggests that crude tanker market will perform slightly better as compared to product tanker market in 2026. Now, sorry for the. So on the demand side, although like prima facie, if you look at the overall oil demand growth, it will be a moderate growth in 2026, growing by around 0.7 million barrels per day, which is similar to the growth in 2025. But there are three main key factors which will impact the demand side of the story for both crude and product tanker market. Specifically for the crude tanker market, we have seen the recent unwinding of the OPEC production curve that has resulted in supply glut in the crude tanker oil market, and which has supported rates in the crude tanker market. Now, although OPEC has paused the production for Q1, but despite, even if the cartel keeps the production at December level, there will be significant oversupply in the market in 2026. Now, it will only the time will tell whether the cartel will come back to the production curves again to support prices or not. But depending upon the OPEC's action, there will be significant change in demand in the sector. Similarly, overall, the Russian crude flows, that is the outlook for this Russian crude oil flows is highly uncertain. At the moment, the peace talks are going on, and at the same time, the sanctions, European and US sanctions, have tightened in the recent months. So, which way the eventual outcome will go, that is highly uncertain. Whether the peace deal will be finalized, and that will pave the way for Russian crude to return to European market, that is still questionable. So depending upon the outcome, whether Russian crude flows normalizes or it gets squeezed further, that is a big uncertainty at the moment. Similarly, one thing, the last thing, which is Suez Canal traffic. So although after the declaration by Hamas to stop attacking the ships passing through the Suez Canal, the traffic has not recovered significantly, or at least it has not returned to the pre-crisis levels. So there again, there is still not very much clarity on this, whether the ships will return and pre-crisis traffic levels will be achieved or not. So depending upon these three factors, there will be a lot of uncertainty on the demand side for the crude and product tanker market. Now, if we go in detail one by one on these three issues, so you can see the overall oil supply growth was around 2.6% in 2025, and that is mainly on account of speedy unwinding of OPEC production curves. So that led to a surge in oil supply towards the end of the year, and which in turn resulted in strong demand for crude tankers, especially VLCCs, because it resulted in increase in the Middle Eastern crude exports to Asia. Now, if we see if the OPEC keeps the production at, say, December 2025 levels, in that case, we can see another 2.7% growth in supply in 2026, which if we compare with just 0.7% growth in demand, so it suggests that there will be a significant glut in the market, and which will obviously impact the overall tanker demand in 2026. But depending upon the OPEC's stance, whether they'll cut production going forward or they'll further unwind the production curves and increase the inflate this oil supply in the market, that is still questionable, and which will impact the market significantly. If you see this chart shows the overall supply-demand balance in the oil market. So in 2025, there was like oversupply to the tune of 1.9 million barrels per day. And now if we assume that OPEC keeps production at December 2025 levels, then in 2026, this oversupply will increase to 3.3 million barrels per day, which in a way is a massive, and I'm not sure that level of oversupply will be there in the year, or there'll be some further OPEC action we'll have to see. Now, depending upon the possible outcomes, we have three possibilities. One is the OPEC keeps production at December level. So as I mentioned earlier, if we keep the production at December level, there will be still very significant oversupply in the oil market, especially in the first half of 2026. And if that is the case, in that case, obviously, onshore storage will be overwhelmed. And that eventually might lead to an increase in floating storage. So both the situation, like increase in onshore storage and then eventually increase in floating storage, that will be positive for the crude tanker rates because it will underpin the tonnage utilization in the market. The second possibility is OPEC further increases the production, which in my opinion is like the least likely out of the three. Now, in this case, obviously, we can see supply glut similar to the COVID-19 2020 levels, wherein all of a sudden, that was, however, driven by a sudden slump in oil demand, but this time it will be because of the surge in supply. So in both cases, like be it the oversupply obviously will lead to increase in floating storage. At the same time, initially it will lead to increased in stocking activity. So both will be positive, and rates we can see a surge in rates similar to 2020. And the third option is which to me it appears to be like most likely, that OPEC rebalances the oil market. So although they have paused the production until first quarter 2026, but eventually they'll resort to the production curve going forward to rebalance the market. And in that case, obviously, oil prices will kind of rebalance to support the oil prices after initial decline in first quarter. And this will result in slightly lower demand as compared to previous two scenarios. So we can see some softening in the charter rates in the tanker market. Here I'm talking about crude tanker market. Now, another major uncertainty is related to Russian crude flows. So there are two major possibilities, like Russia-Ukraine peace deal, and if that doesn't happen, maybe there is possibility that sanctions on Russian crude that will increase further, and which might disrupt the Russian crude flows. So in both cases, we'll discuss what will be the possible outcome. So we have assumed four scenarios, like if Russia-Ukraine peace deal, if that happens, then in that case, there are two possibilities. One is the Russian crude flows to Europe, that will revert towards the pre-war levels. And second is Europe continues to avoid uh, Russian crude despite this peace deal, and the trade patterns remain intact. Uh, if we talk about the first case where the old pre-war trade patterns revives, in this case, obviously, because that will lead to a surge in short-haul trade, which will obviously hurt the ton-mile demand for mid-sized tankers. At the same time, normalization of Russian crude trade, that would mean like dark fleet will return to normal trade, and which will inflate the supply. So both on the demand and supply side, it will be negative for the crude tanker market, especially for the mid-sized tankers. Now, the second possibility where the trade pattern will remain similar despite this peace deal. In this case, obviously, the ton-mile demand for mid-sized tankers will be stable. Again, the dark fleet will return to normal trade, and that again will inflate the overall tonnage supply. So overall, you can say tonnage utilization will be slightly better in this case as compared to the first one which we have discussed. But overall, this possibility of Russia-Ukraine peace deal, that will be negative for the crude tanker market, especially the mid-sized tankers. Now, if this doesn't happen, in that case, there is a possibility that there will be further disruption to Russian crude flows. We have two scenarios here. Like one is India reduces Russian crude imports because of the sanctions. But in this case, we have assumed that okay, China in place of India, China will absorb that additional Russian crude, and overall Russian crude will remain more or less intact. Whereas in this second scenario, we have assumed that overall Russian export that will shrink. So in the first scenario, where we are assuming that eventually the Russian crude flows will be diverted toward China, in that case, obviously demand for dark fleet will surge because of long haul trade from say Russia to China, that will increase at the expense of short haul trade to India. So that will be negative, and especially that will boost the demand for dark fleet, and we can expect like in such a scenario, Russia would purchase more older tonnage, and that is eventually like tighten the supply in the for normal trade. In the second scenario, where we are assuming overall Russian crude flows will shrink, that will be obviously negative because for mid-sized tanker, both the Russian crude flows to China and India, that will decline. So mid-sized tanker demand will decline. And in this case, obviously, Middle Eastern crude export will increase at the expense of Russian crude, which will benefit VLCCs in particular. And again, weak demand for dark vessel in such a case will underpin demolition. So this particular case will be positive for VLCCs. At the same time, it will absorb some of the oversupply from the oil market because Russian crude flows will go down. Now, the last part where we are considering the normalization of Suez Canal transit. So far, we have not seen any significant improvement when it is like when we talk about crude tanker transits through crude from Suez Canal. But yes, if this traffic normalizes, obviously there'll be a shift in trade pattern. After this Red Sea crisis, demand for VLCCs for Middle Eastern crude exports to Europe, that increased because the vessels were taking Cape of Good Hope route. Now, once if this traffic normalizes, that traffic will switch back to mid-sized tankers. So this possibility will hurt the VLCC demand. At the same time, Suezmaxes, although that will be a short haul route, short haul trade route, but overall volume of trade on mid-sized tankers, that will increase, which eventually you can say in this case, mid-sized tanker will benefit from this. But all in all, we expect that because of oversupply in the oil market, uh, crude tanker market will outperform the product tanker market, especially considering the fleet growth will be relatively slower and inventory stocking activity will be high, which in turn will support crude tanker freight rates. So for the product tanker market outlook, I'll invite Anshika. She will take you through the major factors which will impact product tanker market in 2026. Anshika, over to you.
Yeah, thank you, Rajesh. So, as Rajesh Verma has already discussed about the fate of product tankers market, that is a surge in fleet growth is haunting the product tanker market. And of course, we expect that crude tanker will outperform the product tankers in 2026. However, two major demand drivers. First is easing of Suez Canal transits, and the second is peace deal of Russia-Ukraine war, will further pressurize the product tankers market. So I'll first talk about the Suez Canal transits. So as you can see that in from April 2025, the LR2 transits from northbound has recovered slightly. However, they haven't surpassed the last 5 years average. As you can see in 2023, the transits were touching 75 tankers in a month, but they have remained significantly lower in October 2025. But they can recover because this after the announcement of Houthis, uh, there are so much chaos in the market, and people are expecting that if this time the peace deal holds, we can see that the transits can recover, and this will be a huge negative for product tanker market, which benefits from this rerouting in last year in 2024. And and in the second chart, we can see that the COGH transit have also increased, but they remained almost stable. And so we expect in 2026 that we have to keep an eye on the Suez Canal transit, and it will have a huge impact on product tankers ton mile. And the second major demand driver is the Russia-Ukraine peace deal, which have provided additional support, a huge support to product tankers market. So Russian diesel, Russia has replaced diesel, and it was and Brazil and Turkey emerged as the largest buyer of Russian diesel. On the other hand, Singapore and Taiwan were the largest were buying naphtha a lot from Russia, which has increased the ton mile demand of product tankers. However, in 2026, if this peace deal hold, and if Russia-Ukraine war will be resolved, then we expect that Brazil will stop taking Russian diesel, and it will replace it from US, and which will be negative for LR's ton mile. And at the same time, if Asian buyers, if Asian country replace naphtha, replace the Russian naphtha, and they will increase naphtha buying from Middle East and India instead, it will increase the short haul trade, replacing the long haul trade, which will be negative for LR, supporting more employment to MR instead. So all in all, we expect that product tankers market will set to moderate in 2026, but these demand factors will create additional uncertainty for product tankers market. Now I want to invite Tanisha Mundra, and she'll talk more about the tanker equities. Yes, Tanisha, over to you.
Hello everyone. A bit about our maritime financial research before I start talking about the tanker equities. So under our maritime financial research, we provide fundamental equity research on 32 maritime companies, which are primarily listed in US and European markets. Broadly, we have three verticals within financial research: equity research, financial advisory, and valuations. Under financial advisory, we do project assessments and provide industry sections, while under valuation, we offer shipping and port valuation, company valuation, and fairness opinion. Now coming to the tanker equity, on 2025 year has been very volatile year for the tanker market, especially for crude tanker market. Every quarter brings in another development in the market. First quarter, it was all about the sanctions and tariffs. Second, it was about the Iran-Israel war and the OPEC plus increasing their production supply. This has continued in quarter three as well, which have led to creating excess supply in the market and the need for floating storage, because of which the Drewry crude tanker equity index has increased 52.2% YTD, and it has significantly outperformed the S&P 500, which has rose 16.8%. On the other hand, Drewry product tanker equity index followed a different trend till September mid. However, post that, because of the stronger crude market, product tanker stocks rose well, and the index has now risen 15.2% YTD. However, the index is still underperforming the S&P 500. High asset prices have also led to a significant increase in the net values of tanker companies, further supporting the increase in the stock prices. Coming to the company performance of 3Q25. So if we speak in 3Q25, crude tanker companies and product tanker companies have both seen a weaker results, given that most of the company had already booked 70% of their operating days for quarter three in quarter two. And at the same time, ongoing fleet renewal meant several companies were operating with smaller fleet, which reduced the available revenue days and pulled TCA revenue down. If we compare, product tanker revenue decline was much more than the crude tanker companies, because of the pressure which has been created by excess supply in the market, which had a huge impact on the spot rates. On the net income side, if we see, crude tanker companies actually performed better. Even though TC revenue was softer, many owners benefited from capital gains and lower interest rate. Companies like Sarcos, TK, and DHT reduced their interest expense quite aggressively, and which have helped overall profitability. As for the guidance given for 4Q25, the higher rate momentum seen in 3Q25 is expected to carry through 4Q25, and we expect that 4Q25 earnings should strengthen, supported by higher forward bookings and gains from ongoing fleet renewal. As we can see that in percentage term, frontline shipping has actually booked their VLCC at 132% higher than the last year. So in all, we expect that the profitability for 4Q25 would be notably high. So this is the 32 companies under our coverage, which we follow in our maritime financial research. And under crude, we follow CMDT, DHT, Nordic, TK, Sarcos, and Frontline. As for product tanker, we follow Ardmore and Scorpio tankers. That's it from my side.
Thank you, everyone, for this very informative presentation. We've had a few questions coming in already. We're just running a bit short of time, but we'll try to answer a couple of questions in the remaining time we have. So first question for Rajesh or Anshika. What's your outlook for second-hand prices in 2026?
Okay, so there is not like the trend will be slightly different for crude and product, as we have discussed that vessel earnings and charter rates in crude tanker market will be slightly better as compared to the product tanker market because of the better utilization slower fleet growth and strong demand. So obviously that will reflect on the asset prices as well. So as we have seen recently that VLCC especially the prices going up. So we expect like as long as there is an oversupply in the market and there is no quick action from the OPEC and rates remain high, in that case obviously we see the asset prices in crude tanker market that will hold around the current levels, whereas in the case of product tankers, obviously whatever firmness in rates it will get, that will be mainly firmness percolating from the crude tanker market. So obviously we see some softening in the second-hand prices, because obviously there will be fresh tonnage influx in the market, so demand for second-hand tonnage will be slower, or you can say weak. So yeah, overall, the asset prices of product tankers will decline as compared to crude. Yeah.
Thank you, Rajesh. One more question, if I may. We have seen a rise in new ordering for VLCCs in the past months when the rates have surged. What will be the impact on the crude tanker market?
Okay. So obviously the if we see the deliveries scheduled for crude tanker market after 2026, there will be significant surge in deliveries in 2027. Although the overall, you can say, age profile, if we see the age profile of crude tankers, the average age is going up. So that suggests that at some point of time, eventually, there will be increase in scrapping activity. However, at the same time, if we see the long-term prospects, because the oil demand will going forward decelerate gradually at some point, although it is still a big question whether it will peak in 2030 or 2030 or mid 30s. But eventually, the one thing is clear that growth rate will gradually taper down going forward, which will, you can say, squeeze the demand. So it's better that any just because of a surge in current freight rates, if there is any increase in ordering, it will negatively impact the future outlook or long-term prospect for the crude tankers. Nonetheless, whatever the replacement tonnage demand is there, there will be ordering for that. Yeah.
Thank you, Rajesh. So that's all we had time for today. This brings us to the end of this webinar session. Thank you, everyone, for joining us today. We will be sending out a link to the recording of this webinar, as well as a link to the presentation, if you would like to review later at your own time. Thanks again, and we look forward to seeing you at another Drewry event. Have a good day.
Thank you, everyone.
Thank you.
Thank you.